Welcome back to Golden Rule Radio. We hope all of you are doing well this week. We're going to start this week's show with platinum because the platinum price has broken our previous high of around 875 and it's currently above 900. I really like this action, especially after the base we built. So looking at platinum, looks like it wants to go higher. Probably going to have a little bit of a pullback, just like any market would, from the 900 level, or maybe a little bit higher. But we like this turn in platinum. I think that has been the turn.
Sure. Higher low, higher high, building a new channel, heading up to some of those other highs from previous years. For the last couple of weeks, I've been saying, don't know how many more times we have to say, look at platinum. Now the question is, how many more opportunities are we going to get to look at platinum? Because we start seeing 950, 1,000, and then pushing up to the 11, 1,200 mark, and that ratio disappears pretty quickly.
That is what I'm most excited about. And, this is exactly what we've been waiting for gold to do. Didn't really expect the white metals to lead the charge other than the fact that Palladium's been doing this. So the platinum palladium sectors have been a little bit more of their own separate little entity. Gold and silver as the money metals have been acting more consistently as money metals. But here we are seeing that ratio correct. I'm excited about it. These are not small numbers. You're up 17% in platinum from that low to this now new high. And at the same time, palladium is down almost 12%. So look at what that's doing to shrink that ratio. Really, it's at 0.65 to 1 now. And I'm excited for our clients because we've been trying to get our clients to understand the big picture of being in platinum in this type of an environment, and we will see platinum go to twice the price of palladium again.
Well, think about it. What in your own life has gone down in price? Obviously the cost of living hasn't gone down as most Americans would see. Because if you look at where platinum was, it was over $2,000 an ounce 10, 11, 12 years ago. So in 10, 11, 12 years, what of the things that you buy every day are down that much? 50%, 60%? And we're talking about something that is 5, 6, 7, 10, probably more times rarer than the quantity of gold in existence. So jumping from platinum to gold, gold is undervalued. Gold's at 1,300, 1,310, something around there today, which is good. It held that base. We'll talk about that in a minute. But gold at about 1,300 is undervalued. And the inflation-adjusted price for gold would be above 2,000, with platinum being more than half of its price from its high, about $2,300, $2,400 an ounce. And with gold being undervalued, and the platinum-gold ratio obviously is showing platinum undervalued, platinum is moving, and you're not going to be able to buy it under $1,000 an ounce pretty soon.
I agree. And, you bring up the 10, 11, 12-year mark. Back in 2008, when platinum was at $2,200 an ounce, gold was at $1,000. Right, so don't forget that. Before gold took off and went up to 1,900, platinum had been there and beyond, as you're talking about, but literally twice the price of gold. So when we're talking about relative value, yes, gold is undervalued. Gold is underpriced. It's incorrectly measured if you don't take into account inflation, right? What are these white metals telling us? Because they are too. So why platinum and palladium? Why oil right now? I know I'm rabbit trailing here a little bit, but any theories on what the global commodity markets are telling us with oil, with palladium, now with platinum with such a significant increase? Again, not at highs, but in terms of that percentage move.
Well, Tori, that gets us back to the conversation we had with our special guest, Rob McLaughlin, a couple weeks ago when we were discussing not just the pricing and charting of platinum and palladium, but also availability, where the mine's located, what's the supply availability, what's the demand on the market. And
industrial demand.
Industrial demand, exactly. Not just investor demand like we generally discuss. So when you're talking about for the most part, just a couple countries that the platinum and palladium production comes out of and how tight the margins are on that availability of product, it doesn't take a lot of demand change to really affect that price action. And I think that could be what we're seeing right now.
Well, circling back to gold, since we started to transition there, will you run us through the gold charts and the technical analysis?
So after gold came into that high back in February, we've come back down to that 382 fib level. And last week, we were sitting just above that 1285, 1290 mark. And hopefully looking for a push lower. However, that hasn't happened, and I think a lot of that may come off the news of them lowering economic expectations for 2019, seeing that gold price pop back up. So we still have to get back above 1320, and obviously we have to get back above that 1340, 1345 number to retest the old highs. But it's very encouraging for you guys that are long-term bulls on gold and understand the fundamental reasons to own it. The fact that we had such a shallow correction here. I mean, only coming down to the 382. We tested it 3 times. It never even got lower than the previous time it was tested, let alone pushing below the 382. It's incredibly bullish looking to me right now. And if we continue back up and get above the previous highs, I think we will be, if not exceeding the old 1370-ish mark and pushing up towards 1400.
You know, I appreciate those numbers, Miles, and I think just if we take into account seasonal trends, which we can't discount, we do tend to quiet down a little bit in the summer months. And we did just get a little bit of a pop on, like, the IMF, for example, just came out and cut its outlook for global growth to the lowest level since the financial crisis, right? It's a much bleaker outlook globally, not just domestically here, but globally for the world economies. And they can say it's higher tariffs or whatever else. But commodities are actually leading the charge here a little bit. I personally believe, from that macro fundamental standpoint, that we will see gold break down below that fib number, and you will see the lows that you've been predicting. And I think it'll occur in the summer months, and that's okay. I also think that some of these economic numbers can start to turn a little bit only because of the fact that they're not raising interest rates. They may even, earliest in my opinion, cut rates starting in the fall if that's not the case. So if they don't get the result they want just by not raising interest rates right now, if it doesn't give the economy and the equities markets the boost they're hoping for, then they will cut it. Because the fact of the matter is they know it's negative, right? Not just the United States. The whole world knows that the global economy is slowing down. It's a healthy recession. It's okay.
You know, and I don't entirely disagree with the idea of having a summer seasonal turn down. My big concern there, however, is the guy who's sitting on the fence waiting for a $40 drop. When I know that a $40 rise puts us into brand new territory, and a $40 rise breaking out of that zone follows with about a $100 rise.
I agree.
So
and
it
that's
ends
when
up,
we position.
Yeah, and what ends up happening is instead of having the opportunity to buy today at $13.10 because you wanted to buy at $12.50 or $12.60, you end up buying at $13.65 or $13.70 because it had just turned down from $14.25.
And with my clients, I'm cost averaging in for that very reason. You're right. Robert's been saying this for 6-8 weeks. Every time we touch 1285, he's screaming from the rooftop, buy now. 1300, buy now, you know? So add to your ounces. And I think we're saying the same thing. If it breaks lower, that's just another opportunity to add to your ounces, but that doesn't mean you let the price get away from you. If we see your target point on the upside, we break through that resistance and we're at 1370 and beyond, by all means, that's when you put the rest in.
Sure. And as Robert mentioned, I mean, with the inflation-adjusted numbers up over $2,000 an ounce today, who cares? What's $50 at this point? If we're talking 700, 800, 900, maybe 100% return, if we see that type of event play out like we had in 2009, 2010, and we look at substantially higher gold, silver, platinum, and maybe even palladium prices.
Well, and add that to the ratio play of gold to silver, right? We're still recommending that you buy gold right now in the form of silver. So we can sit here and talk about the gold price, but really our focus too is equally on silver. With that ratio being so askew, you're going to end up with more gold later by buying silver now, using gold as your technical entry points.
But to close out gold before we move to silver, Tori, obviously, I can't deny the good old-fashioned head and shoulders pattern, and we still haven't seen a right shoulder fall yet. So if we don't push up to that 1375 mark, we're not looking at higher territory. We move into seasonal pricing. Absolutely. We're still looking at lower gold prices by around the middle of this year. If we get above it, the lower gold prices are going to be higher than where we're at now.
That's right.
The last thing I'll say about gold is there seems to be a lack of urgency going on with people considering buying gold. And I will say, gold's going to leave you behind. It's up, 25% in the last 3 years since the bottom. it's quietly doing this. It's been building a base. It's been constructive. And we're talking about these little moves in here, in the week-to-week program. But gold is going to go higher and it's going to leave you behind. Just like what platinum just did at about a 15-something% move. We've been telling people to get in. I wouldn't wait. I mean, this early part of the summer is going to be your opportunity, and then it's going to go higher. So if you're sitting on the fence out there, just make sure that you buy before it starts to rise against you. Touching on the other two markets before we leave the markets and jump to geopolitics, the dollar index has been in a 3-point range. Goodness, it seems like forever. Just watching paint dry between 97.5-ish to about 94, 95 since about October of this last year. And so it's still there. It dropped below 97 recently, but it's still stuck in this range. The other market, the stock market, we're at a moment of truth with the stock market. It's rallied back. It's gone to a little bit of a recent high, but it's not back above the all-time highs. And so it looks like it could try to roll over here, but you have a lot of momentum on the upside as well. So it's at a moment of truth. It looks like it's running out of steam here, but traders are wanting to push it higher and shoot for that number and shoot for breaking to an all-time new high and shoot for higher prices. So traders want the momentum to keep going up, but it does look like it wants to roll over. So it's at this inflection point. We'll be watching to see where it goes.
I think it's lost some of its steam strictly because of the fact that it's now old news that the Fed's not raising interest rates. I gave it a little boost, and now we're going to see it maybe sort of run out of steam, and that's sort of what I was talking about earlier before too, is the fact that we're going to see those interest rates potentially stay flat or be reduced. Geopolitically, I think the key piece of information to speak about today, it is official. Benjamin Netanyahu is once again Prime Minister of Israel. So certainly one of the expectations would be continued geopolitical tensions in the Middle East, as far as Israel being the center or the core of some of those tensions. And so don't look for a whole lot of change that way. And then also, I'm going to ask the question on this oil rally. Is it a harbinger? Is it a barometer? Is it predicting something? Because global recessions or economic recessions certainly go hand in hand with rising oil prices. So it's not a commodities boom necessarily as much as it is a stimulant to further accelerate downturn in economies. It gets more expensive. So with that being said, appreciate you guys listening this week.
If you liked what you heard, click the button to subscribe, ring the bell, head on over to our website, McIlvaney.com, Facebook, McIlvaney Financial, Twitter @ICA Gold, or give us a call anytime, 1-800-525-9556.
Thanks for listening. Have a great week.